Selling options is a great way to increase your income, doing things that you would do anyway. In this video, we're going to talk about how to sell options using Fidelity, some different ways to lower your risks, just some smart option selling strategies in general. We're going to get into it right now. So the two different options you can sell are covered calls and cash secured puts. There are others, such as the uncovered call, which you can also sell, but I recommend staying as far away from an uncovered call as possible because the downside for those can be massive. A covered call is when you have 100 shares of a stock and you give someone the right to buy those shares from you at a set upon strike price. A cash secured put is the opposite. You have enough money to buy 100 shares and you make money to buy it at a certain strike price. So we'll talk about covered calls first, then we'll go into cash secured puts. So covered call, you have those 100 shares. There are a few different ways you can approach this strategy. One is that you think a stock is overvalued and you want to sell it. In this case, you would set a covered call right at the strike price, which does limit your upside. But if it does match up with your thesis that this is overvalued and you just want to get out, rather than just selling the stock, you can make some extra premium along the way. And you could even set the expiration date a little further out if you're willing to do that. Setting the expiration date further out increases your premium, but in this scenario, an overvalued stock can go down and you are ending up with a bag in terms of the depreciation of the stock price, but you do get a premium to kind of act as a cushion. If you have 100 shares of a company you believe in and you want to keep, but you still want to collect premiums, there are a few different ways you could go. One is weekly options that are very far out of the money, where you earn a little bit here and there. You can also increase the expiration date, increase the strike price. You make less money per month, but you do increase the likelihood of you keeping those shares. So those are the different ways you can approach covered calls. One thing you could do as the market goes through its typical week, because all these covered calls and cash secured puts, all these options expire on Fridays, unless you are trading SPY. In that case, you have 3 different expiration dates each week. So the different ways you could approach if the stock continues to go down and your covered call, and we'll talk about cash secured puts later, and your covered call decreases in value, the way you get into the position is you sell to open. That's how you initiate the covered call or cash secured put. You could then buy to close a little early and get those profits. You can even buy to close a covered call that drastically drops in value, and then you can proceed to sell another covered call to the open to collect additional money. The way that you feel about a stock, the way the overall stock market is, will depend on your decision. Because when you do sell another covered call, you are essentially lowering the strike price, lowering your potential reward in the event the stock skyrockets. Similarly, if the stock is moving up and really getting close to the strike price of your covered call, you could decide if you want to sell at that moment to take your losses and avoid getting assigned. To compensate, maybe you go further out with an expiration date with your next covered call so that you can recoup some of those losses, keep the stock safe. Sometimes, though, just because a stock goes over the strike price doesn't mean it's going to get exercised. I've had a few cases where the stock price goes above the strike price, but then ends the week below the strike price, and I get to keep my shares. This is not always a good scenario, because if you wanted to get rid of the stock, you have to keep it for a little bit longer. And if you wanted to keep the stock and it goes above the strike price, well, you have to sell it at that set strike price. This is where people can miss out on some gains. If you set a strike price of $100, the stock rises to $110, then you have to sell at $100. So if you want to sell a stock, set the strike price closer to the current price. If you want to keep the shares, set a further out of the money strike price. Maybe even do this at the end of the trading session on Monday or Tuesday, you don't make as much money. But if you do it at the end of a trading session, there's not as much volatility that can happen versus if you are someone who is trading these at 9:30 a.m. Eastern, where the market has the most amount of volatility. So that's an idea of the covered call. Now we're going to talk about the cash secured put. In this scenario, I only recommend selling cash secured puts, not to chase the premium, but to make decisions you would want to make anyway. So if you do weekly cash secured puts on an index, then the index drops to that level, you are forced to buy shares. This could be really great if you wanted to get into the index anyway, but maybe you want to buy it at a lower price, kind of like how people set a regular strike price for stock purchases, ignoring that the strike price for the cash secured put, people will set strike prices and say, I'm okay with buying the stock at this price. You can get paid to agree to buy 100 shares at a set price. Furthermore, you could set far out cash secured puts. So one of the things I recently did with a Pinterest put is I sold a Pinterest put 45 strike price expiring May 21st, 2021, really far out expiration date. $45 is really far out, is implying a lot of downside for the stock. I made $798 from selling that position. That is the amount I got paid, which means a few things. One, I have an instant 17.7% return on that investment, which beats the market average in less than a year. If Pinterest shares do go below 45 and I am assigned, I have no problem adding an extra 100 shares of Pinterest to my portfolio, especially at that price. My break even is not 45, which is the exercise strike price of the put, but it is rather $37.02 to reflect that I made the $798. So you could do a really far out of the money cash secured put that also expires really far out as a way to increase your return, beat the average returns you get from the market. And then if you are assigned, you get the stock at a much lower price than what it currently is. That's why I believe with cash secured puts and covered calls alike, you should be selling options that complement the decisions you would have no problem making anyway. This is a strategy that really makes a lot more money than dividend investing. One thing to note is that unless you're buying options that expire more than a year out, all of these are going to be taxed as short-term capital gains, which means the 35% bracket unless something changes and it becomes 40%. In any event, think about that when you are filing your taxes, because these aren't exactly getting taxed at the long-term gain levels. Options trading is really great if you know how to utilize it to your advantage and you make decisions that match up with decisions you would have no problem making anyway. Cash secured puts are, to me, like making dividends on cash. And if you get assigned, as long as you're getting assigned something you have no problem with getting, such as an index, then you can do a covered call to make even more money, or you could just let the shares ride. Just because you have the ability to do covered calls and cash secured puts each week doesn't necessarily mean you should or have to. So sometimes it's better to just sit it out for a week. Maybe you think the market's going to boom and you don't want to do covered calls, get caught up in that. Or maybe you are a little nervous about some volatility and you don't want to own any shares. You want to hold on to your cash, in which case, maybe just sit out for a week. You don't have to play this every single week. You don't have to sell options every week. Dividend investing is more passive. This strategy makes more money, but again, you could sit out and you could make longer term plays if you want to. One final thing about options is when you're selling them, you have to pay attention to the dates. One is the ex-dividend date. If you have a covered call that you are selling and the ex-dividend date, let's say, is Wednesday and you sell on Friday, you get the dividend, because the dividend is paid out to the people who own the shares at that time. So in the case of a covered call, you would have still had those shares. In the case of a cash secured put, if the ex-dividend date is Wednesday and you get the shares on Friday, even though you had the cash secured put during the ex-dividend period, that does not mean you get the dividend. So that is something important to keep in mind. Some people, they use covered calls for their dividend stocks, make sure that you, if you value getting the dividend, are not selling your stocks through the covered call at the wrong time. Or in the case of a cash secured put, understand that you are not getting that dividend because you sold the option. Although the premium you make from that can more than compensate for the fact that you're not receiving the dividend for a certain stock in the given quarter in most cases, but some stocks do pay twice a year or monthly. Those are some of the things you need to know if you want to sell options. I recommend trying with something very small at first and something like a low price stock, because if you look at an Amazon, you need to compile a lot of money to buy 100 shares of Amazon or enough money to do a cash secured put. So look for a very affordable stock. Affordable is going to be different to each person. There are some stocks that trade at less than $10 a share that still have the ability for you to do options trading, sell options, buy options, which we will be talking about in future videos, maybe on this channel, maybe on my other channel. But in any event, make sure you pay attention to dividend dates. Also, make sure you pay attention to earnings dates, because if you have a covered call on a stock and it skyrockets during earnings, you miss out on that. One of the things I love about Fidelity, I don't know if this is true for all options platforms, is that Fidelity lets you see what the earnings dates are, and it lets you see what the dividend dates are as you are making your decision of which option to sell. So in any event, I hope you guys enjoyed this video. Let me know in the comments if you guys are selling options, if you're getting started, and subscribe if you want more videos like this. Hope to see you guys in the next one.